time will tell if it's a correction or a bear market. The fundamentals have to support it. Now, on that, I will say this. This is a market, and this is a call, correction versus bear market, that teeters on the fulcrum of what inflation does. And I hate looking at tomorrow's CPI report as the Super Bowl of economic statistics, but frankly, it's very, very important. I am a long-term investor, but for the short-term call, whether we're in a correction, whether it's going to get something worse, that CPI tomorrow is very, very important. If it comes in below 8%, I'm going to feel a lot better on the headline year over year. That's what I'm looking for.
Oh, that's the flavor.
I felt he used too many onions, but it was still a very good sauce.
Vinny, don't put too many onions in the sauce.
I didn't put too much onions in. Oh.
All right. Today is Tuesday, May 10th, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight, and let's dive right into it. In focus. What else? The CPI Preview, the cooks at the bureau, gonna be busy. Busy doing what? Cooking a tamed inflation reading, a peak inflation reading, meaning you're going to see some month-over-month readings declining, and therefore the experts are going to come out on TV and say, inflation is peaking, time to put your blindfolds on and buy stocks. We'll talk about that in a minute, but let's go over the stock market and see what's going on right now. The losses are stunning. Astonishing. Whatever word you want to use to describe this, doesn't matter to me. But look at this. Apple, for example, in the last 3 days lost almost $225 billion. That's $250 billion. Apple lost an Elon in the course of 3 days. Microsoft lost almost $200 billion. Amazon, $175 billion in value. Poof, gone. And speaking of Elon, Tesla lost over $150 billion in the last 3 days alone. This is a massive loss. You know, the genius in the intro of the video says, oh, well, we're going to find out in the next few days whether this is a correction or a bear market. And I say, this is a correction? What the hell is wrong with you? This doesn't happen unless we are in a bear market and we are heading toward a crash. And of course, we talked about this in last night's video. Retail traders have now lost everything, gone. All of the gains, the tendies, the to the moon bro, they're gone now, according to Morgan Stanley. And rumor has it, applications in McDonald's jumped through the roof. And of course, the retail crowd bought the dip last Thursday, as we covered in this program, but turns out yesterday they sold and they booked their losses. They gave up right away. So could this be a sign of capitulation? Perhaps. We're seeing the wreckage all over the place. Even the hedgies who used to win, now they're losing. For example, Tiger Capital, which is the top performer last year, at least to my knowledge, they're losing so far $17 billion. One of the biggest declines in history. Look at this. Amazon lost all of the pandemic gains. Everything. Poof. Gone. And of course, we predicted that in this channel last year. We said that all of these Fugazi gains generated via stimmies and print, baby print, all of that fake money and fake gains at some point when the cocaine is a little too much, causing inflation, and we have to take the coke out of the equation. All of these fake gains will come down crashing because, believe it or not, Amazon did not grow that much between 2019 and 2021. The organic growth is pretty much the same, if not less. The only growth they got is due to the stimmies and the free yayo all over the economy, courtesy of the Fed. And look at this. Mama Cathie Wood, Tesla witch Cathie Wood. She's getting slaughtered. In 2020, amidst the heat of the mania and the bubble, the retail crowd described Mama Cathie as money tree. She knows. Mama Cathie knows. Just put your blindfolds on and take my money, Mama Cathie. Well, she took your money and you're not going to get it back because RKKKKK is now underperforming the S&P 500. And this is the first time this happened since 2017. What does that mean? The magic that Mama Kathy had? Well, it's gone now. Apparently, the Holy Spirit has other affairs to take care of beside spitting tickers and trade ideas to Mama Kathy. And Mama Kathy cannot catch a break, folks. Yesterday, Palantir was down over 20%. Today, Upstart Holding down over 50%, almost 60%. Folks, we're talking about a stock losing 60% in a single day. And the guy says, oh, maybe it's a correction. It's not a bear market. We'll see. Here's another one. After the bell, Unity Software down over 34%. So Mama Kathy is getting slaughtered left and right, left and right, left and right. No mercy at all. When we talk about the macro front, your boy Joey B came out today talking about inflation. He's massaging your expectations ahead of the CPI reading. Apparently, Brian Deese from the BlackRock administration, well, turns out he's a good propagandist, but not a good massage therapist, because last time they sent Brian Deese to massage our expectations regarding the upcoming CPI, well, he failed. Stocks went down anyways. So now Joey B says, I'm going to do the job myself. And he gets out and says what? He said inflation is too high, and he understands, he knows that Americans are suffering. But toughen up, bite the bullet for a little bit. We got to stick it to Putin, because this is the Putin price hike. Come on, man. While you suffer at the pump and the grocery store, utility bills, rents, you're getting screwed all over the place. The average American now understands the feeling of getting. But rest assured, Joey B says, I got no relief for you. I cannot give you money or do anything to help you out. I mean, after all, you're not a Ukrainian, because Joey B is about to ship $40 billion of your money to, you guessed it, Ukraine. It went from $33 billion to $40 billion, just like that. Magic. And if you don't like it, well, keep swiping those credit cards up and down, up and down, up and down, because that's the only alternative you got. The headline reads, Americans are putting more on their credit cards and taking out fewer mortgages as they need to borrow more to cover the increasing cost of everyday essentials. So when they say the consumer is strong and hot and better than ever before, retail sales are up to the moon, it's actually because the consumer is chasing inflation, not because the consumer is flush with cash and they're stimulating the economy. Look at this. U.S. household debt over $15 trillion. And that credit card portion is moving higher and higher and higher. And if you say the economy is great, we got the cushion for Jerome Powell to use the blunt force tools, because job vacancies are through the roof. I told you, the job vacancies mean shit. Unfortunately, we used to have a stock market that tracks the economy. If the economy does good, the stock market follows through. But after years of engineering by the Fed, we now have an economy that tracks the stock market. But here's the catch. The economy only tracks the stock market when it goes down, not when it goes up. What does that mean? When stocks start to crash, the valuations of these companies shrink. As a result, companies have to move from capital expenditure to capital preservation. What does that mean? Getting rid of excess employees. Because the demand is going to slow down in the economy. This is what the Fed wants to do right now in tackling inflation, because they have no power over the supply side. They got power over demand. So when they crush the demand in the economy, companies don't need employees anymore. The excess employees. And we're already seeing the alarming signs happening right before our eyes. Uber is freezing hiring. We got the news not so long ago that Facebook is now freezing hiring. And here it is. The stock of Carvana crashed big time. And as a result, now the company is moving to capital preservation. And they're laying off 12% of their workforce. Here comes the tsunami of layoffs. But the good news is the CEO and his dad already cashed out last year at the top of the market. They got billions and billions and billions of dollars. Now they can scoop these shares at dirt cheap valuations and consolidate their power even more. And by the way, I'm not saying that Carvana's valuation is dirt cheap. I'm just saying at some point it's going to get dirt cheap, and these criminals will scoop up the shares and consolidate their power even more. You see how rigged this game is? We have an economy that only works for the 1% for the oligarchs. For the rest of us, forget about it. But when the economy sours and stocks crash and the corporations start to scream and complain, oh, we have to bail them out too. What is this? It's a f***ing joke. But rest assured, all of this FUD and the scary talk, what's up with the FUD, bro, right? Well, you got the perma bull Ed Yardeni, who's a great economist, by the way, but he remains, I'm trying to find a nice word here. I'm probably not going to find it, but How about obtuse? You like that one? He remains obtuse about the reality of this economy, and he sees the S&P 500 rebounding to all-time highs next year. Not only that, but also the economy avoiding recession. And rumor has it when Ed Yardeni wakes up in the morning, looks at the mirror, tells himself that he's 27 and chicks are still into him. But rest assured, we got a lot of good signs here. That a rebound could happen, and this time it's going to happen for real. It's not just going to last for 3 hours and then we get served a lot of pies in the face. This one is the real deal. Third time is a charm, baby. At least according to David Tepper, who covered this short. I covered my short 2 weeks ago, a little too early, but he covered his short yesterday in the Qs. And of course, when these top hedge fund criminals cover their shorts, you know they got the news that the CPI is going to be cooked to perfection, and therefore cover your shorts, go along, you know the deal. But now let's talk about the CPI, and let's play a game. And the game is cookable or not, which sounds like the dumbest game show on the planet, but hey.
I'm not that clever.
Now, when we look at the survey, and this is for U.S. adults, those who say we are very concerned, this is not concerned or somewhat concerned, this is very, meaning I'm shedding my diapers right now. Among the Gen Zers, 45% say they're very concerned about inflation. 52% of millennials, 63% of Gen Xers, and 70% of boomers. Uh-oh. Of course, the boomers, a lot of them on fixed income, so inflation is killing them. Inflation is a major problem for boomers and retirees. We have an election coming out. They're going to make their voices heard. If Joey B doesn't fix inflation, forget about it. But let's play a game here and see whether the cooks at the Bureau are going to be capable of cooking the CPI data again and give us a peak inflation reading. Which item will be cookable enough to give us the peak inflation reading? This is the data from the World Bank, because a lot of you say, hey, bro, you're a conspiracy theorist. Buddy, I get my information from the approved sources by the Ministry of Disinformation. The Washington Post, CNN, the World Bank. So here it is from the World Bank. The WTI went down by 6.7% month over month. So that could be cooked, right? They could say, crude oil prices went down by 20 points. Here you go. On the other hand, natural gas went higher by 1.65 points. Here's the problem for the cooks. Not everything is cookable when it comes to energy, because U.S. distillate stocks fall critically low. What are they talking about? Here it is. You see the distillate inventories? You see that white line? This is where we are right now. We're not even within the range of 2021 or the average at all. The inventories at all-time low. Likewise, motor gasoline inventories are dropping like a rock, and soon enough they will fall below the average. And today we heard from OPEC, and the kingpins sound the alarm over the world's dwindling energy capacity. What are they talking about? Here it is. The Saudi oil minister said, I am a dinosaur, but I have never seen these things. Prince Abdulaziz bin Salman, who has been attending OPEC meetings since the 1980s, said Tuesday at a conference in Abu Dhabi, referring to the recent surge in prices for refined products, the world needs to wake up to an existing reality. The world is running out of energy capacity at all levels. So again, the supply nowhere to be found. You could say, well, what about the reserves? Saudi has a lot of oil. Venezuela has a lot of oil. This country has a lot of oil. The problem is, it's easier said than done. It takes years and years to build the infrastructure to increase the capacity. On top of that, the crisis in energy right now is not oil or natural gas. It's actually diesel. Diesel fuel is in short supply as prices surge. What are they talking about? Here it is. Diesel fuel inventories at all-time low, and the prices to the moon, as you can see. What does that mean, by the way? Everything, the backbone in this country, by the way, is diesel, trucking, railroads. Everything we buy and consume in this economy is transported via diesel. This increase in price that the truckers and the railroads have to incur will be passed down to, you guessed it, you and I, the end consumer. So when they say the CPI is going to peak, bullshit. There's no peak in sight at all, despite the cooking. Now, what about certain softs, like coffee, for example? That went higher by about 15 cents month over month. But bear in mind, food prices at all-time highs in April. They eased by a notch So that could be the catalyst behind any peak inflation reading, but it's tough to cook. It's not easy. For example, while we have palm oil down $94 month over month, soybean meal down $22 month over month, soybean oil down 9 points month over month, soybeans flat, yet you have wheat, hard wheat up $9 month over month, and soft wheat is up $139.4 per metric ton month over month. Bananas up about 7 cents month over month. Beef is down about 12 cents month over month. On the other hand, chicken up 33 cents month over month, and oranges up 14 cents in the same period. But here's the problem. We have leading indicators, for example, Tyson's earnings that we got yesterday. Well, the profits of Tyson are soaring, and the reason is the pricing power. They're doing a lot of price gouging, some justified, some not justified. It doesn't matter. At the end of the day, your job as the CEO is to test the limits. Do price gouging until the consumer says, no mas. So when you hear Biden and Warren saying the source for inflation is price gouging, baloney. This is a symptom, not the cause. But again, a leading indicator is Tyson, and Tyson says, no. The prices of meat and chicken, those are moving higher, not lower. And of course, now the pitchforks are coming against Tyson. For example, New York State is issuing a subpoena against Tyson, accusing them of price gouging. What's more important is inflation expectations. When we talk to the consumer, the grocery store, whether you're seeing prices moving higher or down, we can see prices moving higher across the board. Over 70% of correspondents said that they're seeing beef and pork prices moving higher. Over 70% say produce prices are moving higher. Eggs, chicken, turkey, milk, snacks, everything is moving higher, according to the consumer, despite the cooking and the false data by the government. Now, what about plywood? That's down about $28 month over month. And then we have cotton up 31 cents month over month. And then we have fertilizers up across the board month over month. So again, can you cook cotton prices? Of course not. Can you cook fertilizers? Of course not. But fertilizers are going to show up later on because the farmers have to pay now and they pass the extra cost later on. What about metals? Aluminum down around $254 month over month. Copper down 70 points. And then we have lead, which is critical to this nation's water supply. Well, that's up about 35 points month over month. And then we have nickel down about 791 points month over month, but again, remains highly elevated. Of course, we got the short squeeze back in March, and that contributed to the spike top. And now prices are moving down month over month. But again, put it in perspective, nickel prices are still too high. The highest we've ever seen, even after the drop month over month. So the cooks at the Bureau have room for maneuver here to give us a peak inflation reading, but it's not going to be easy. You got energy in oil, that's about it. They can't cook diesel. When it comes to food, some items are down. Maybe they can cook something over there in food, we'll see. What about rents? Rents, well, the vacancies remain historically low, meaning prices are moving higher. And the trend so far is rent inflation is up 2.5% year over year. Now, this chart could be deceiving because you see 2021, the year over year increase is significant, but it's due to the base impacts. In 2020, rents went down big in cities like LA, San Francisco, New York. Absent of that, 2022 is the highest year in recent memory when we talk about rent increases. Now look at this. Maybe we're seeing rent increases month over month stabilizing for now. But honestly, I don't know where they get this data because they say Miami rents went higher by 7% in the past 6 months. In San Diego, 4% in the past 6 months. Are you kidding me? I can show you rents here in San Diego that doubled year over year. The increases are over 100%. But again, we're going to play with what we have here. We know in reality, rents are out of control. Evictions are soaring again, coast to coast, because rents are out of control. Yet the CPI says rents went higher by only 4% year over year. Maybe the weighting of Branson, Missouri is a little too much in the formula. Now, what about used cars? Can the cooks do anything with used cars? Perhaps. Look at the Manheim Used Vehicle Value Index. In April, the index went down. And here's the specific reading. Look at this. In March, the reading was 223.5. In April, the reading for the index went down to 221.2. So yes, they can do something with used cars and say, hey, look at this, peak inflation. The problem is, when we look at the year-over-year increases, all in all, the increase in used cars prices went higher by 14%. And of course, the number one category is vans. Prices of vans went higher year-over-year by almost 30%. Why? Because this is the new American dream. It got reduced from a house with a picket fence to a one-bedroom apartment, to a studio apartment, to a trailer, and now all the way down to a van. That's the American dream. Thank you to the Fed. Thank you to Jerome Powell. Thank you to the oligarchs, the criminals, and their puppets in D.C. But forget about the Mannheim. According to car gurus, the price trends are moving higher across the board. For vans, up 1% month over month. For wagons, up 1.5% month over month. The same goes for coupes, sedans, convertibles, hatchbacks, all moving higher month over month. So we'll see if the cooks can work something out here when it comes to used vehicles prices. Now, what about airfare? Can the cooks do anything over there? Let's hear this report and the reality that's going on right now.
LA, Boston, or Mexico. Wherever you're hoping to fly this summer, chances are you're seeing some shockingly steep ticket prices.
Right now, airfare is rising rapidly. From the start of the year, airfare is up about a quarter.
This flight from Tampa to Los Angeles in June was running about $327 just 2 months ago, at an average of $215 to $310 according to Google Flights. Now it's at least $300 more, the cheapest round trip sitting at $625 on Spirit Airlines.
The overarching thing that's happening right now is demand is back. Right now, Americans want to travel as much or more than they did pre-pandemic,
which is leading to strong demand. And that's demand for flights, cruises, hotels, rental cars. Just for Memorial Day specifically, we're seeing bookings twice or double that of what we saw last Memorial Day weekend.
Recent stats from an Adobe Digital Economy Index found domestic airline ticket sales were 6% higher February of this year than 2019, while corporate ticket sales are far below pre-pandemic levels and less planes are in the sky. Airlines for America shows flights are carrying more passengers. That's shown by the blue line here.
At the same time, airlines are saying, hey, for the last 2 years, we lost a lot of money. Let's try to recoup those losses. Demand is back. Let's charge as much as we possibly can.
But that's not all.
What's behind the higher airfares are a combination of strong demand, inflationary pressures, and rising fuel costs.
During the pandemic, less people traveled and airlines let go of a lot of employees. Now that demand is back, they're struggling to restaff. On top of that, they're facing an increase in fuel charges due to the war in Ukraine.
Jet fuel is about a third of most airlines' operating expenses.
Here's a look at current jet fuel prices according to Airlines for America. You can see they're the highest they've been since 2008.
And here it is, the inventory of jet fuel pretty much at all-time low. We're getting close. So realistically, they're not going to find any relief from airfares. So the cooks have used cars, the WTI, certain metals, and then certain food items that they can work with and give us a peak inflation reading. And if that happens and the market believes it, then the indices will shoot up higher and we will see a short covering rally and we will identify targets when we talk about charts. But for now, I gotta move on to cover the stock market information for you, and we start with the performance of indices today. And here we go. The Dow Industrial Average down by 84.96 points, or a decline of 0.26%. The Nasdaq in the green by 114.42 points, or a gain of almost 1%. The S&P 500 also in the green by 9.81 points, or a gain of 0.25%. The sector's performances were led by technology at number 1, capturing the gold medal, and at number 2 for the silver, communication services, number 3 for the bronze, healthcare. Meanwhile, the laggards of the day led by REITs, utilities, and materials. We're talking the heat map analysis, but is this the beginning of the rebound in growth led by technology and communication services? We've seen at least 2 attempts before, and both of them ended in failure, so we'll see. But here's the advance, the decline ratios. NYSE 37% advancing versus 60% declining. The Nasdaq 42% advancing versus 54% declining. Commodities, crude down, and we're talking down big. Both the WTI and Brent down over 3.5% today. And so was gasoline, also down a little over 3.5% now. Remember the video that I produced, whether this is the crash of 2008 or the initial shock of 2008. And I mentioned that crude oil is the leading indicator. If we see crude falling apart, then this is the crash. And it's about to get really, really ugly. It doesn't make sense because the Fed hasn't tightened yet, but again, the market is a game of expectations, meaning the stock market can crash and the economy does just fine, but then the prediction of the stock market plays out in the economy, and we see the economy dipping into a recession. For example, back in 2008, when the economy started to feel the pain in around 2009, the stock market actually bottomed, and it was the greatest buying opportunity of all time, perhaps, even though the economy struggled for the next few years. So could this be the leading indicator happening right before our eyes? Perhaps. So keep an eye on crude. If we continue to see declines of 3.5%, 5% per day, then that's going to be really alarming. On the other hand, we have heating oil up almost 3%, and then natural gas rebounding higher and gaining almost 4% today. Softs, we have declines across the board, be it modestly, led by coffee, lumber, sugar, and cocoa. On the other hand, we have cotton in the green, pretty much in the flat line, modest gains, and then OJ scoring gains of a little over 0.5 percentage point. Metals, the weakness, remain here. The dollar continues to move higher, but tomorrow is going to be a critical day for the US dollar and the 10-year yield. If both of them go down, then we will see a massive rally in metals. For now, gold was down, silver down. The pain in silver is noticeable. Silver is down almost 3% today. Likewise, copper is down, palladium is down, be it limited losses of under 1% for both. On the other hand, we have platinum gaining 0.75% today. When we talk about meats, feeder cattle futures down almost 1.5%, and then we have feeder cattle down almost 1%. On the other hand, lean hogs is rebounding modestly, just under 0.5 percentage point today. Grains, we have sizable gains for soybean oil, gaining a little over 1.5%. Likewise, we have gains for soybeans, corn, wheat, rough rice. On the other hand, soybean meal pretty much in the flat line, while we have losses led by oats, down over 3%. Oats is down big since the top. Likewise, canola is losing about 3% today. Now, the most important commodity when it comes to grains inflation is wheat. Because without wheat, prices are going to move higher, and we will see a starvation crisis in other countries like Egypt, Bangladesh, etc., because the Ukrainian exports are nowhere to be found. Although the Ukrainians are attempting to export wheat again, but there is a massive problem here. But since the Russian invasion of Ukraine at the end of February, grains shipment of all kinds, including barley and rye, as well as wheat, have been blocked from exiting Ukraine. Nearly 25 million tons of grain are currently sitting unused in Ukrainian storage facilities. Of this, up to 12 million tons of wheat destined for global markets could fail to leave Black Sea ports because of the blockades. The plan to export Ukrainian wheat through foreign countries seem to be in place, but officials remain wary about one key obstacle that could still derail the whole thing: infrastructure and the difficult logistics of getting Ukrainian wheat to foreign ports at all. So the plan is to move Ukrainian wheat to Latvian ports and then get it out to the global market from there. It's going to cost more either way, but at least consumers will get the end product, and we will see wheat prices moving down. They're going to remain elevated because now you're routing wheat from Ukraine all the way to Latvia, which is going to take longer to get to the global markets down in the Middle East, Africa, Asian consumers, which means they're going to pay higher prices for it anyways. But here's the problem. Number one, the south and the eastern region of Ukraine is the top producers of wheat. Guess who occupies these regions now? The Russians. And it's not just wheat, by the way. It's barley, it's metals, it's minerals, it's neon. So the Russians are capturing a prime piece of real estate here. On top of that, number two, the problem is the Russians have been bombing infrastructure, be it bridges, be it railroads, and the reason is Western weapons are being transported using that infrastructure. So the Russians are bombing these railroads and these bridges, so even if the Ukrainians are able to get the wheat out of the east and they want to move it north via Poland, for example, where is the infrastructure? Where is the safety? Anybody who wants to transport wheat out of Ukraine is going to charge more. So we still have problems here, and wheat prices will maintain these elevated levels for a long time. Moving on to the options market, the big casino, what do we have here? The volume remains dead. No participation at all. What does that mean? The indices are failing to sustain any pops, and the reason is nobody's buying calls. We have to see market participants buying calls in order for any confirmation to happen that this rebound will be sustainable. Could getting the CPI out of the way encourage market participants to buy calls? Perhaps, or is what we're seeing right now is a reflection that retail mom and pops, market participants are dead. And if that is the case, then we're not going to see participation in buying calls at all, even if the CPI comes out with a peak inflation reading. Anyhow, Apple came at number 1 at around 1 million contracts traded for the name today. Around 51% of those were calls. At number 2, Tesla, the souffle, at around 500,000 contracts traded today. About 50% of those were calls. At number 3, AMD, at around 450,000 contracts, but 69% of those were calls. Here are the unusual activities that took place in the options market today. We start with the ticker TTD. This is for Trade Disk. The name reported earnings after the bell, and somebody got it right, at least for now. But in all likelihood, they're going to lose money either way, even though Trade Disk after hours is moving in the direction that they're betting on. So this is an options market trading lesson for all of you. In this case, they're buying the 35 puts for the expiration date, May 13th, meaning this upcoming Friday, and they're expecting TTD to go down by 20% by then. They paid around $2.25 a piece to enter this trade, all in all spending around $3 million. Here's the problem. The stock is down, 5% after hours? Meanwhile, the expectations are for 20% plus drop. In all likelihood, even though the stock is down, they're going to lose money in this trade either way. And the reason is they did not give themselves enough time. So if you're going to buy the weekly expiration options, you're pretty much gambling. There is no science to justify buying weekly options with 3 days till expiration at all. Unless you have insider information, that's a different story. But you buy options with 3 days till expiration, and you pay $225 a piece for them, that's a problem. And therefore I say open spreads, limit your risk, give yourself enough time. Otherwise, you're just gambling. Anyhow, what about the ticker KSS? This is for calls, and they're not buying calls on calls. Matter of fact, they're buying puts this time around, the 37.5 puts for the expiration date, July 15, with expectations that the name could go down by more than 24% by then. They paid around $3 a piece to enter this trade, all in all spending around $3 million. What about the trade for the ticker QQQ, the NASDAQ? They're buying calls. Interesting. The 330 calls for the expiration date, June 10th, with expectations that the Qs could rebound higher by more than 10% by then. They paid around $2.30 a piece to enter this trade, all in all spending around $1.3 million. And what about the strangle trade for MAS, Masco? They're buying calls and puts. They're not sure if the stock is going to go up or down, so they're buying both calls and puts, but there is a bias here, and the bias is the more likelihood move is to the downside, at least according to the trader. Why? They paid more for the puts than the calls. They're constructing the trade in a way where they can capture profits if the stock goes down by more than 6%, or if it pops higher by more than 13%. So they're saying, okay, if the trend continues and the stock continues to go down, we make money. It goes down by more than 6%. But if we have a short squeeze, a rebound rally due to the peak inflation CPI, or whatever, then the stock could pop higher by more than 13%, and they can capture profits that way. They paid around $2 a piece for the puts, and they paid around 70 cents a piece for the calls, all in all spending around $2.7 a piece for this trade. And that brings the bet all the way to $1.6 million. Continuing with interesting trades, what about the ticker IWM, the Russell 2000 small caps? They continue to buy puts, and in the long run, they're going to be right, but in the short run, if we have a peak inflation CPI reading, or we get a relief rally, a short covering rally in the aftermath of that, then why open the trade right now? Why not wait after the CPI? After the stock market rebounds and becomes overbought again. But perhaps they're confident that the CPI will not save the stock market from its inevitable fate. And in this case, they're doubling down on buying the 166 puts for the expiration date, June 17th, with expectations that the name could go down by more than 5% by then. They paid around $4.75 a piece to enter this trade, all in all spending around $2.2 million. Moving on to the heat map analysis, do we see a theme here? Perhaps not, because the map is all over the place. But when we concentrate, we can see a theme here. They're dumping some of the defensives, Walmart, the packaged food names that we talked about in yesterday's video. They're also dumping REITs and utilities, perhaps capturing more profits from these two sectors too. Likewise, financials are down. There's no profits to be captured over there, that's for sure. And we're seeing the inflows in energy back again, buying the dip. A lot of energy names were down big, and folks are buying the dip. We're also seeing some of the leisure and hospitality names rebounding higher. Not all of them. But most importantly, we're seeing the big caps, the software names, chips moving higher. So we have a theme where you got REITs and utilities as the underperformers, and then you got energy and technology as the leaders of the action today. What does that mean? Is this the beginning of risk on? Is this the beginning of a rotation of buying the dip in technology, the beaten down names in software, the RKK kind of names? Well, it depends. Is the CPI about to give the green light for buying the dip in the beaten down names? Or will the CPI result in more pain for the dip buyers and the bulls in this market? Therefore, I continue to say, why not wait for the CPI? You got a short trade. Last week, we talked about the numbers. We said if these numbers, these support lines are broken, you want to short. Now you shorted, you captured some profits. Why not wait, see how the CPI is going to look like, and then make your decisions accordingly? Here are some corporate news for you. We start with Peloton. The name is already in the trash, but perhaps it has more pain to experience. And by more pain, I mean down to zero, because shares went down today again after the company produced huge losses and offered weak guidance. And by the way, Peloton is running out of cash. Now, in this environment, they cannot sell bonds or go to the Fed or the credit market for relief. So once they run out of cash, the only option available is bankruptcy. Yep. We also have SoFi down big after releasing the quarter's earnings a little early due to an accident, quote unquote, and as a result, the stock was down big. And then we have Electronic Arts. They're losing the FIFA name for their popular video game. The contract has been going on for over 30 years now. It is a legendary game, but now they're going to lose the name. It's still going to be the same game. They're just going to lose the right for the name and perhaps other products, for teams, for example, for certain players. And now FIFA has the option of licensing all of that to a competitor of EA, and therefore watch out for this name. And speaking of video games, good luck getting your PlayStation 5 because the shortages are likely going to continue. Today, Sony released earnings, and believe it or not, the earnings are good actually. If you're looking for companies producing gains and growth amidst this inflationary environment, well, Sony's doing pretty good. And then you have the devaluation of the yen and the Bank of Japan easing. I see Sony as a good name to look at this point, to consider. I'm not saying buy, I'm just saying consider it. Look at it, do your homework, and let me know what you think in the comments. But for now, we're moving on to the heat map for the ETFs. Again, perhaps this provides a clearer theme than the individual heat map because we can see clearly that growth, the IWF, the VUG, outperformed value. When we talk about the VTV, the IWD, they're all down, be it modestly, but growth scored gains today. The majority of the gains came from chips. As you can see, the SMH up over 2.5% today. The SOXX is up over 2%. Not sizable gains for old school technology because the XLK was up only by 1.5% today. But you can see the gains in the NASDAQ stemming from biotech. The XBI was up over 5% today. Energy muted in the green, but muted. We're seeing pain in real estate, utilities, consumer staples, materials, the XME, XRT, retail, the regional banks, KRE. So again, is it the beginning of a rotation to buy the dip in technology? Perhaps. But when you look at this map, you're not seeing the confirmation yet. We're seeing some strength, some short covering in chips and some of the big caps, and that lifted the NASDAQ higher. Yet when you peel the onion, you're seeing losses in software names, in the high beta, RKK kind of names. So we don't have conviction yet. Perhaps we have shorts who scored big, and they're saying, why not book some of these profits ahead of the CPI? That's all what happened today. And therefore, we're moving on to charts, and we start with SPY, the S&P 500 30 minutes chart. We got a gap up in the morning that got us all the way to 405, and then the sell-off came right away, gap and crap, but the dip buyers showed up again. It's actually not the dip buyers, it's the short coverers, the not-so-greedy shorts. They say, okay, we made a lot of money, let's book some profits. Or perhaps the recent shorts who shorted last Friday, now they're saying, hey, let's just book profits. Why not take the risk ahead of the CPI? And immediately, the SPY rebounded higher, but it did not make it all the way to 405. although it formed a bull flag pattern. So the question now is, will the bull flag play out? The answer is yes, if the cooks give us a peak inflation reading in the CPI, but most importantly, whatever reading they cook for us, it has to be received warmly by the stock market. There has to be no doubt at all that this is indeed peak inflation. How do you confirm that the stock market is receiving this reading warmly and saying, okay, we believe the cooks at the Bureau? Number one, the dollar is going to go down big. Number two, the 10-year yield should flush down big. Otherwise, we don't have a confirmation. Because guess what happened last time around? Jerome Powell did what he did in the conference, no 75 basis points, and right away the indices blasted higher. The Nasdaq gained over 3% in a single day. But we did not get a confirmation from the Dixie or the 10-year yield. We saw down days in the Dixie and the 10, but not enough to confirm that the pop that we got after the FOMC is sustainable. So watch out here not to get trapped after the CPI reading. Yes, we could get a peak inflation reading, but we see the indices gapping higher right away. And then what do you know? The market opens and we see the selling continuing right away. And we see another gap and crap. Watch the dollar and the 10-year yield. Those are your leading indicator. Forget about the pattern. Forget about the bull flag. The bull flag could play out or it could not play out. That's the truth, by the way. The technical analysis means nothing at all if it's not confirmed by the fundamentals and the psychology. So keep that in mind. Now, when we look at the daily chart for the continuous contract with SPY, the good news is the chart went down in a test of the support of 3,960 and it rebounded higher from that point on. It continues to hold on at 3,960 as support. This is the good news for the bulls. If that support is broken, then the bears are going to double down and short again. Yet if the support is held and we see the chart moving higher impulsively above 4,102 once again, then this will be a leading indicator that we have a short covering rally. The shorts are looking at the CPI and saying, okay, they're going to move stocks higher. Let's book profits. The shorts stampede to the exit door at the same time, and that causes a massive move higher. A new confirmation that that's happening is this chart moving higher above 4,102. And here's the SPX. The good news is the cash index continues to hold on at the very critically important psychological level of 4,000. If 4,000 is broken, we got a massive problem. The algos will get triggered, the shorts will double down, and we could see a massive flush down here. But if 4,000 is held, or we get a confirmation that 4,000 is the bottom for now, the confirmation would be reclimbing 4,114.65. If that happens, then you know 4,000 is a bottom for now, and the shorts will cover, and we will see a move higher, perhaps all the way to 4,200, if not more. Here's the Q's 30 minutes chart. Again, a gap higher, then came the crap, but the chart held on to the support of 297.5. That's the good news. We got some buying. Again, the assumption is these are recent shorts, booking profits right away, forming the bull flag pattern. And the bull flag is going to play out if the CPI comes out showing peak inflation. And the target could be closing the gap at around, let's say, 309. If that is closed and we see a move higher again, the resistance becomes 313. Here's the daily chart for the continuous contract for the Qs. The good news is 12,207 is kept as support for now. The bad news is it doesn't matter if that support is held or not. If the bulls don't get us all the way above 12,766 by the end of the week, and better yet above 13,300 once again, you're not going to have a confirmation that this is a short covering rally. Of course, by the time the chart gets to 13,300, it's going to be obvious. You don't want to miss on that rebound from this point on all the way to 13,300. So your confirmation would be closing the day above 12,766. And here's the IWM 30 minutes chart, or an hourly chart, excuse me. There's nothing to look at here. The last support of 188 is already broken. There is nothing to look at here. If this chart fails to reclimb 188 by the end of the week, then the assumption is any rebound will be short-lived. Yes, for now we have an imminent crossing in the MACD indicator, calling that perhaps we will see a green day in the IWM after the CPI reading tomorrow. The question is, who gives a shit? Until the chart gets all the way above 188, there is no real recovery here, technically speaking. Here's the Dixie. Is it going to be up? or is it going to be down? We know a massive move is coming here. This is the chart of the day, the week, the month. It's going to be the chart of the day tomorrow after the CPI. If we have a flush down, losing 103 as support, and you see an acceleration of the losses in the dollar, you know for sure that this is the real deal. This is not going to be another trap, just like we got last week and the week before that. Is third time a charm in the SPY and the NASDAQ? This chart is the key. And then we have gold. Look at that. Gold is down to the next Fibonacci support, which coincides with the trend line. If we zoom out, here it is. You can see the trend line. It was resistance before. It should be support for now. If that line is broken, you got to get out of gold, because this line will only get broken if the dollar pops higher along with the 10-year yield after the CPI. And of course, it doesn't make sense. I get it. If the CPI goes higher, shouldn't gold also go higher? This is what happened back in the 70s. Not this time around. The Fed distorted everything. You cannot rely on what happened in the 70s to happen again this time around. And here is UK oil, Brent. We're looking at a 4-hour chart. The support of 105.84 has been broken. And every attempt that we got today in reclimbing this number again was met with failure, which means that the next support will be 100. The problem is, are you seeing what I'm seeing here? Is this a double top formation? And if it is, it's going to get us below 100. If we see an acceleration of losses in crude, then you know this is it. This is the end. We're going to crash. And here's the chart of the 10-year yield. Again, a very steep trend line that is pretty much impossible to break above again. We're seeing weakness in the momentum indicators, all with slightly negative divergences, but you cannot rely on the technicals here to call tops at all. Calling the top has to be confirmed by the fundamentals, and the only fundamental news that we got is the CPI, aka the CPI. If we see the 10-year yield going down to 2.8, for example, then that will be a confirmation that we're getting weakness in the 10-year yield. We're going to see short covering in the TLT. Here it is, weekly chart. And if that happens, you got a confirmation that at least we're going to get a relief rally in the equities, the NASDAQ, the SPY, and this time around the rebound is not going to last for 3 hours. Maybe it's going to last for days or maybe a few weeks. But the confirmation is the bond market and the dollar. In this case, the TLT heavily shorted and way oversold. Any good news on the CPI front will cause a massive short squeeze that could take us all the way up to 125.12. Notice that everything I'm saying right now is assuming that the CPI will come out with a peak inflation reading. If it doesn't, if we come out with 9.5, forget about it. We're going to see the resumption of the sell-off. Here's a 4-hour chart of the VIX. The indices have been going down dramatically. The VIX holding steady eddy. We will see why we have this divergence perhaps by tomorrow after the CPI. If the VIX flushes down big time, then he got the answer. The VIX has been predicting that the sell-off in the stock market is overdone. But if we see a massive pop in the VIX, a resumption of the selling, then perhaps the reason behind the divergence and the shy reaction by the VIX so far is market participants are not seeing the need of hedging. But after a hot inflation reading once again, perhaps they will see the need for hedging once again. For now, technically speaking, the bulls would argue, the VIX bulls would argue, look at this. We still have 33 as support. The pattern is still making higher lows. The momentum indicators remain positive for now, but the VIX bears will counter and say, yes, the momentum indicators are green for now, but they're losing strength. Number 2, the chart, the pattern for now is making lower highs, and the chart is about to lose 33 as support. That could happen by tomorrow. And if the chart loses not just the support of 33, but also the trend line, that's it. Good night, Irene. We could see the VIX down all the way to 20 rapidly. This is at least what the VIX bears see. Now here's the VXN, the VIX for the NASDAQ. We're seeing massive downside in the NASDAQ, yet the VXN continues to hold ground. It is not popping higher in a dramatic way. Is this a prediction that the sell-off in the NASDAQ is overdone? Or is it market participants being complacent and callous about hedging? We'll see the answer, and the answer will come out tomorrow. For now, the VXN bulls, the NASDAQ bears, would say the momentum indicators are green. That's number 1. Number 2, the support of 40 remains intact. The chart is making higher highs. There's no problem here at all. The NASDAQ bulls, the VXN bears, would argue, yeah, but you're losing momentum. Number 1. Number 2, why didn't the VXN rally higher when the Qs was down big? That means sooner or later it's going to lose 40 as support. We will see a flush down, which will come hand in hand with the bull flag in the NASDAQ from a 30 minutes perspective playing out. Now, here's the most important name in the NASDAQ, Apple. It is keeping the support of the lower end of the channel. That's the good news. It is attempting, slowly but surely, to recapture 157 as support. The bad news is there is no participation in the options market buying calls in a significant way to support any move higher. Number two, we're not seeing the momentum indicators showing any sign of bottoming for now, meaning the chart remains in negative momentum. That could change. That change could be induced by a peak inflation reading in the CPI. We'll see. With that being said, Apple has a lot of ground to cover because getting 157 as support, that's not enough to buy. I want to see 172 being recaptured as support before I buy. Otherwise, any rebound should be assumed as a dead cat rebound until we get to 172.4 and the chart recaptures that as support. Here's Tesla, a 30 minutes chart. What's going on here? We got a gap higher in the morning. All the way to what? 825.25, almost to the penny. And then it pulled back, breaching the last support at around 802.41. And then we saw the short covering, the baby short covering, and the chart went back to rebattle 802.41 as resistance, back and forth, with no conclusive action, at least today. But when you look at the hour sign, the MACD indicator, Tesla has what it needs technically to blast higher and close the gap at around 865. But that's not going to happen without a fundamental catalyst. By now, you know that the only fundamental catalyst is a CPI. Moving on to tulips, BTC. Massive flush down all the way to 30,000. Could 30,000 be the support for now? The chart is getting way oversold. It is due for a rebound. The rebound will be confirmed if we have risk on, the CPI enabling a risk on environment at least for a few days, if not weeks. Then we could see a massive rebound in BTC and it could recapture 35,750. But if it breaks 30,000, you bet you're going to see margin calls, and these margin calls, by the way, could impact stocks because you got to sell something to cover for the margin call. And before we conclude, let's revisit Microsoft and revisit what I said about this chart right after the Fed meeting last week. Here's Microsoft. I'll give you an update because over the weekend we talked about this chart in a trade, a call option spread. For now, we're seeing a formation of a reverse head and shoulder, and the support of 270 is intact. Also, look at the MACD indicator from the daily chart perspective. It is producing green impressions on the histogram indicating positive momentum coming. If that is the case, we could see resistance number 1 filling the gap at around 297 and then resistance number 2 at around 310, closing another gap. Now, I discussed this trade on Sunday, buying the 290 calls, selling the 300 calls, all for the expiration date May 20. And the entry cost was $2.50 a piece. Now, you could have gotten this spread, by the way, today in the morning for a lot cheaper, but this is how I presented it to you last Sunday, so we'll stick with this. Anyhow, the spread so far is trading at around $4.30 a piece. So this is a gain of around 70% so far. I'm keeping the trade on, and the target will be 300 because the trade is capped at that point. If we get there too fast, let's say by tomorrow or Friday, then I'm going to book profits right away. I'm not going to roll because in all likelihood the move came too fast, too soon, and we will see a pullback. And here it is, did not play out, and the chart breached the most important support, which is 270, And this was the line in the sand to abandon the spread if we see a break below 270. Now, if you did not close last week with a 70% gain, well, you went down big this week because Microsoft went below 270. Now, you could have booked, what was it, 50 cents that was left of the trade. To me, the trade is dead. It has 1.5 weeks before expiration, so there is no point at all in closing the trade because, to begin with, we structured the trade to limit our losses by buying a spread. So instead of paying $7 a piece, the calls, we paid $2.50. So there is no point or incentive to close the trade at this point. It's a wild shot. Just let it ride and see what happens. The break even is around 8.5% to the upside. Could it happen in a week and a half? It certainly could. We've seen crazier things in the stock market. It will certainly happen if we have a short squeeze rally, a short covering rally. But the odds say it will probably not happen. In all likelihood, this trade is toast for now. So is it worth it to salvage the trade by averaging down? The trade right now is worth what, 70 cents a piece? Okay, let's say you buy the same quantity. Once again, you bought batch number 1, now you buy batch number 2 of the trade, and you average down. Well, even if you do that, the break-even target moves down to 8.2% from this point on, down from 8.5%. it is not worth it at all. You should not average down right now. You should say to the chart of Microsoft, show me the money. Let's get the CPI out of the way and move this chart above 280, 285, and then we're talking. If we get to 285 by the end of the week, for example, then there is a shot that next week Microsoft could be above 290. And then it's worth it to average down. But averaging down right now is too premature. And lastly, here's a chart for AXP, a monthly chart for American Express. We're looking for shorts. Shorting software, RKK kind of names, that's done. That should have been made last year. But now you have shorting opportunities in the travel, leisure, hospitality. All of these names are being pumped higher, being fluffed up higher based on the reopening optimism, which is never going to happen, by the way. The economy is heading into a cliff, and we're going to face a recession instead. So the shorting opportunities are here, but this is a monthly chart. We have an imminent crossing in the MACD indicator indicating negative momentum about to happen. We have negative divergence on the RSI, and we have a clear trend line that goes all the way back to 2009. Now, bear in mind, this is the extreme bearish scenario. I'm not saying this will happen, but if we have a massive panic and a sell-off and fears of a recession, this stock, this chart could go down another 46% all the way down to the trend line. So I'm shorting this name, not via options, but shorting for real by borrowing the shares, and the risk is defined. If the macroeconomics data change, indicating that we're seeing more activities in travel and leisure and the fears of recessions are cooling down due to inflation peaking or whatever, then you know you're on the wrong side. You cover your shorts and you move on. But for now, the assumption is these travel and leisure names are becoming way overbought, way overvalued due to another story, the reopening story. Remember the software, the RKK kind of names, the story was the future bro. But once the Fed started tightening, the future bro story goes out of the window. Similar story with the stay-at-home stocks. The story was this is going to be the new normal. You're going to use Zoom, Peloton, DocuSign. That's going to be the new normal. And therefore, the insane valuations back in 2020 were justified. And now we know that that story is bullshit. And I believe that the reopening story is another bullshit fantasy. That's never going to happen. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? In case you were asleep throughout the video, we have the CPI, aka the CPI. And the cooks are going to be busy in the morning, attempting to serve us a cold meal. We'll see if they're going to do it or not, but for now, this is all I got for you. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.